Join me as I walk you through my updated stock watch list, revealing the companies I've been planning to buy in 2026. And in today's video, we'll go through 3 stocks in total that I think could be great investments at the right price. And for each, I'll also share my latest price target. Now, if you'd like a deep dive into the rest of my portfolio, feel free to check out my channel as well. And let's start off with the first stock in my watch list, beginning with Nasdaq. Currently, of course, the stock has a 0% weight in my portfolio as I haven't started to invest in the company yet. However, I've given the company a final star rating of 3.5 stars, which I'll talk more about later on in the evaluation. Now, the company has a market cap of $52 billion as of today, and the stock is up roughly 17% year to date. Now, if we take a closer look at stock performance year to date, we can see that the stock at one point was up by 25%, and since then the stock has retraced a bit by roughly 8%. However, if we zoom out a bit, we can see that the stock has more than doubled over the past 5 years, meaning that current investors have gotten more than 20% annual returns from the stock, which is absolutely massive. Now, Nasdaq isn't just a stock exchange. In fact, that's now the least interesting part of the company. Over the past decade, Nasdaq has transformed itself from a traditional trading venue into a global technology and data powerhouse. Today, nearly 70% of its revenue comes from recurring subscription-like businesses such as anti-financial crime software, index licensing and ETF partnerships, and data analytics. And this shift has made Nasdaq more stable, more predictable, and more profitable as a company. And as you may know, Nasdaq also operates one of the most influential indexes in the world, the Nasdaq 100, which powers a massive ecosystem of ETFs and index-linked products. Add the rise of passive investing and growing global trading volumes, and Nasdaq's long-term runway is stronger than most investors realize. Now, let's take a look at my summary of my valuation for Nasdaq, and we can see that the current share price is roughly $90 per share. Now, my fair share price lands at roughly $68 per share. This means that the stock is trading at roughly a 33% premium versus that fair share price, and the annual return that we as investors could get from the stock is around 11% per year. Now, given that the stock is trading at a slight premium, I've given the stock a hold recommendation and just 3.5 out of 5 stars as my final rating. And this kind of shows why I haven't really pulled the trigger on Nasdaq yet, right, and why the company is on my watch list. It's an amazing company with a strong competitive moat, right, but it's trading at a premium. So my plan is for 2026, if the company comes close to my fair share price, I may start a small position in Nasdaq. And here you can see basically an overview of the growth rates I've used in that valuation for Nasdaq. So for revenue, I'm assuming basically between 14 and 17% growth per year, right, in the coming 10 years. And free cash flow, I'm assuming slightly higher growth each year, right? So given that the stock is trading at a slight premium, despite of these kind of bullish estimates, right, is why I'm waiting to enter stock at a better price if possible in 2026. Okay, so let's take a quick look at an investment positioning landscape. Here we can see the undervalued stocks to the top, and we can see the great stocks to the right. So we basically want stocks that are up to the right in this investment positioning matrix. Now, I'd actually place Nasdaq over here, right? I think it's a great business, one of the best in the world, right? But it's just a bit overvalued in my opinion. So hopefully if the price goes down, then the stock may move upright to the undervalued part of this matrix, and then it becomes a possible addition to the investing edge portfolio in 2026. Okay, so let's move on to the second stock in my 2026 watch list, and that is Netflix. Of course, the company has a portfolio weight of 0%, as I haven't started any position in the company so far, and I've given the company 3 out of 5 stars as my final rating. Now, today, Netflix has a market cap of around $457 billion, and the company is up roughly 21% year to date. Now, taking a closer look at Netflix stock performance during the year, we can see that the stock was up by 51% at one point during the year, right? But as we saw with Nasdaq, right, the stock has corrected since then. Now Netflix stock is down by 18% compared to its year-to-date highs. Now, also zooming out a bit, we can see that like Nasdaq, right, Netflix has doubled over the past 5 years, showing that investors have gotten more than 20% annual compounded return from the stock, and this has been of course a massive winner for many investors. And Netflix has quietly pulled off one of the most impressive turnarounds in tech. After years of slowing growth and tightening competition, Netflix has reinvented its entire business model, introducing an ad-supported tier, cracking down on password sharing, and pushing deeper into gaming and live content. And the result? Subscriber growth has re-accelerated and revenue is rising again. Netflix now reaches over 270 million subscribers worldwide with a footprint in almost every major market. But the real story isn't just scale, it's leverage. Every new subscriber adds incremental revenue to a global platform where most costs are fixed, which means profitability compounds over time. Now let's take a closer look at the summary of my latest valuation for Netflix. So we can see that the current share price is around $107 and my fair share price lands at around $79, implying that the stock could be around 36% overvalued and that we as investors could get around 12% annual returns from the stock. Now given that the stock is trading at a premium, I've given it a hold recommendation and just 3 out of 5 stars as my final rating. And this is basically the same case as we saw with Nasdaq, right? This is an amazing company, but the stock is just trading at a premium, meaning that I'm waiting for a better price to enter, possibly in 2026. And yeah, here you can see all the growth rates I've applied in my bullish valuation for Netflix. So we can see I have a growth rate for revenue at 15% in 2025. That's basically in line with the company's guidance. And then to stay conservative, I've decelerated growth all the way down to 7% in 2034. And here I'm also assuming that free cash flow will grow at a higher pace also, right, than revenue in the coming 10 years, assuming that the margins of the company will expand and the company will become much more profitable at the same time. So let's see where I would place it in the investment positioning landscape, and I would place Netflix over here, right, quite close to Nasdaq. Now I think both companies are amazing, but I would say that Nasdaq is slightly stronger, right, in terms of competitive positioning, but Netflix is of course also extremely strong company. Now hopefully if the stock price declines, right, then the stock moves up the undervalued section, and then I would think about maybe adding it to my personal portfolio. Okay, so let's continue to the final stock in my stock watch list, and that is Intuitive Surgical. Now the company of course has a 0% portfolio weight in my portfolio, and I given the company a star rating of 2.5 out of 5 stars. Now the company is quite large, it has a market cap of $203 billion and the stock is up by roughly 9% year to date. And taking a closer look at the year to date performance of Intuitive Surgical, we can see that the stock has been on a wild ride. At one point the stock was actually down by close to 18%, and since then the stock has actually regained a lot of those losses and is now positive again year to date. And zooming out a bit, we can see that stock has been on a massive run over the past 5 years, matching the performance of both Nasdaq and Netflix, growing at over 100%. So this of course means yet again that investors in the stock, right, have gotten more than 20% annual compounded returns from the stock. And in short, Intuitive Surgical dominates one of the most powerful long-term trends in healthcare, and that is robotic assisted surgery. Intuitive's flagship system Da Vinci is the undisputed leader in surgical robotics, performing millions of procedures every year. And hospitals keep expanding their Da Vinci fleets because the machines improve surgical precision, reduce complications and shorten patient recovery times, which makes them financially attractive despite the high cost. But here's the real magic. Once a hospital installs the system, Intuitive earns recurring revenue from its instruments and service contracts for every procedure performed. That means as utilization grows, profitability scales with it. Now with a strong competitive moat and rising global adoption, Intuitive is positioned to benefit from decades of robotic surgery still ahead of it. Okay, so let's take a quick look at my latest valuation for Intuitive. Now the current share price is around $570 per share. However, my fair share price lands at just $148 per share. Now this could imply that the stock is around 287% overvalued and that we as investors could get around 9% annual compounded return. Now given that the stock is trading at such a steep premium, I've given it a sell recommendation and just 2.5 out of 5 stars as my final rating. Now I find it quite surprising that the stock is trading at such a steep premium despite of the quite optimistic growth rates I applied in my forecast. So for instance, I'm assuming 17% revenue growth in 2025 and nearly 20% free cash flow growth in 2025 as well, before decelerating both growth rates down to just 8% in 2034 in order to stay conservative. And this is basically why we are doing these valuations for these stocks, right, to get a sense of where the stock is priced relative to its future expectations. And in this case, it's showing us that the company has some really high expectations to live up to its current valuation. Now, I also like to compare my price targets to Wall Street analysts just to see what they think about the stock. And in the case for Intuitive, we can see that the median price target is around $600. Even with 20 or 30% yearly growth rates, this price target is way too high in my opinion. Now, in these instances, there are basically two options. One, that the company outperforms my forecast. The other case is that the growth of the stock actually could decelerate, right? Then the multiple will compress and then the stock price will be cut in half, and then the analysts usually usually adjust their price targets afterwards. And that's why it's always important even to do a quick valuation to see if these price targets are realistic in your own opinion before investing in any stock. And now the question basically is, where will I place it in the investment positioning landscape? Well, I think that Intuitive is an amazing company. It's just extremely overvalued right now, in my opinion. Now, if the stock price declines, hopefully right in the coming few months, then that might open up an opportunity to get into the stock, and then it moves up to the undervalued section, and then I might add it right to the investing edge portfolio. So yeah, now we have reached the end of the video, and these are the 3 stocks that have earned a spot in my 2026 watch list with their respective price targets. Now, if you want deeper valuation breakdowns or a full look into my entire portfolio, you can find those videos on my channel. So yeah, see you in the next one.